What if the most dangerous moment in a market isn't when it's crashing, but when it refuses to fall? That's the question silver is asking right now. Not loudly, not dramatically, just steadily, day after day, holding ground at levels that used to feel impossible. Around $65 an ounce globally and still sitting near historic highs domestically, even after red sessions, even after pullbacks that should have triggered panic. This is the part that feels wrong if you've lived through enough cycles, because markets are supposed to behave a certain way at extremes. They spike, they break, they flush excess. They don't hover calmly at the ceiling, they don't shrug off bad days and move sideways like nothing happened, and they definitely don't stay expensive when everyone expects relief. Yet, here we are. Because this story didn't start today. It didn't start this month. It didn't even start this year. What you're watching now is the final phase of a structure that's been tightening quietly for decades, a structure built on flexibility, leverage, and the assumption that physical reality would always bend to financial convenience. Silver is where that assumption runs out. Today's price action looks harmless on the surface, a modest dip, nothing spectacular, headlines already moving on. But beneath that calm is something far more unsettling. Silver is no longer responding to pressure the way it used to. It's not reacting like a trade, it's reacting like a constraint. And once you recognize that shift, you can't unsee it. For a long time, this setup felt normal. Gold sat still, solid, respected. It was the thing people trusted when everything else fell apart. Silver, on the other hand, was restless. It jumped, it dropped, it made noise, so people stopped taking it seriously. And once something isn't taken seriously, it gets used. Silver was stretched thin, 1 ounce, many promises, leased here, borrowed there, written into contracts that assumed nobody would ever ask for the real thing all at once. Not because anyone planned a failure, but because the system believed silver would always behave. And for years, it did. Every spike cooled off. Every panic faded. Every time silver calmed down again, it confirmed the story this market is manageable. This metal is secondary. Nothing to worry about here. That repetition trained everyone. Traders leaned on it. Institutions relied on it. Pressure worked until it didn't. Because while the paper system stayed busy, the real metal was quietly leaving. Not into vaults, not into long-term storage, into things that don't come back. Circuits, panels, machines, tools that get used and discarded. Once silver goes there, it's not waiting to be sold again. It's gone. That difference mattered more than anyone wanted to admit. Gold can sit forever and still be gold. Silver doesn't sit, it moves, and every time it moved out of the system, the cushion got thinner, nothing broke right away, prices still moved, reports still looked fine, but underneath, the room was getting tighter, less slack, less forgiveness. What people kept calling noise was actually the warning. Silver wasn't being dramatic, it was running out of space, and the moment the market realized silver was no longer flexible, that it had become a limit, the old hierarchy quietly collapsed. There was no single day when the system broke. No red headline, no emergency meeting. What happened instead was quieter, and because it was quiet, it went unnoticed. Silver simply began leaving the system faster than it could return. Not in one wave, but in thousands of small, ordinary decisions that never looked dangerous on their own. Ounces moved out of vaults and into the real economy, into solar panels, into electronics, into batteries, into defense systems, into medical uses. Once silver entered that world, it stopped behaving like an asset and started behaving like a component, and components don't come back. Unlike paper claims or currencies, consumed silver doesn't respond to higher prices on demand. You can't print it, you can't roll it forward, you can't summon it with confidence. Mining doesn't accelerate overnight, recycling doesn't scale fast enough, and replacement always lags reality. But none of that showed up where people were looking. Inventory reports stayed calm. Vault numbers looked solid. On paper, everything appeared fine. That's where the illusion took hold, because inventory tells you what exists, not what's available. What mattered wasn't how much silver was counted, but how much could actually move when pressure was applied. And that number was shrinking, quietly, invisibly. The float thinned not through panic, but through use, through time. At first, the market only felt it at the edges. Selloffs didn't follow through, dips bounced faster than expected. Price refused to stay down. Traders blamed sentiment, volatility, headlines, anything that felt familiar. Structural explanations were uncomfortable, so they were ignored. Then pressure stopped working altogether. Sharp drops appeared, aggressive ones, the kind that used to reset markets, but instead of accelerating lower, they snapped back violently. Bear traps formed not because buyers were strong, but because sellers were gone. Each flush removed weak hands but failed to release supply. The metal simply wasn't there. That's when psychology flipped. Fear stopped being rewarded. Selling stopped feeling safe. And once that happens, markets don't just move differently, they become different. What had been a speculative environment quietly turned obligatory, not by excitement, but by absence. The system didn't announce the change, it revealed it through resistance. Once fear stopped working, the market didn't become euphoric, it became tense. Selling no longer felt like protection, it felt like surrender. And buying didn't feel hopeful, it felt necessary. Not because people suddenly believed in silver, but because they began to sense that waiting carried its own risk. That's the moment a market crosses an invisible line, when participation stops being a choice and starts becoming an obligation. For decades, the system survived on flexibility, not abundance. Silver didn't need to exist in excess, it only needed to circulate. Leasing allowed metal to be temporarily removed and later returned. Rehypothecation allowed the same ounces to support multiple claims. Unallocated accounts allowed exposure without possession. On paper, everything balanced, promises matched promises, as long as nobody pulled too hard. Nothing snapped, and those mechanisms weren't mistakes, they were deliberate. They allowed a small physical market to support a much larger financial structure. They kept prices smooth, they kept volatility manageable. Most importantly, they kept the illusion of liquidity intact, but that illusion depended on behavior. It required holders to stay passive. It required claims to remain abstract. And over time, that behavior changed. As uncertainty grew, holders began converting unallocated exposure into allocated metal. Not as a protest, not as a statement, simply as a precaution. But each conversion did something irreversible. It removed silver from circulation permanently. What had once been flexible became fixed. What had once been shareable became singular. That's when the math began to fail. Institutions that had relied on rolling exposure suddenly faced a different problem. It wasn't price, it was delivery. When obligations could no longer be extended effortlessly, banks were forced into the market not as traders, but as insurers of their own balance sheets. Buying wasn't a bet anymore, it was a repair. And repairs don't wait for better prices. This is where behavior at the core of the system shifted, quietly, without headlines. The same entities that once leaned on supply began chasing availability. The same mechanisms that once suppressed volatility began amplifying it, not because anyone wanted a move, but because the system had lost its cushion. Speculation thrives on choice. Obligation doesn't, and once obligation takes over, markets stop asking where price should go and start asking where metal still exists. For decades, London functioned like gravity in the silver market. You didn't see it working, but everything moved around it. When prices rose too fast, supply appeared. When momentum traders piled in, inventory leaned against them. The LBMA wasn't just a marketplace. It was a stabilizer, the place where excess was quietly absorbed and volatility went to cool off. That reliability trained behavior. New York could speculate aggressively because London would handle the aftermath. Asia could buy because London would smooth the edges. Over time, the market stopped questioning that role. It became an assumption, not a variable, and assumptions are dangerous when they fail. When London opened and didn't sell, it wasn't confusing. It was exposed, surfacing. The metal that usually appeared on demand simply wasn't there to lean on anymore. Not delayed, not tight, missing from the float, and when a system built on availability discovers absence, it reacts instantly. The bids that followed weren't measured, they were urgent. Size hit the market without hesitation. No patience, no finesse. This wasn't price discovery, it was damage control. Institutions that had spent years managing price suddenly found themselves managing risk. That's a very different mindset. This is where the twist matters. London didn't change sides because it wanted higher prices. It changed sides because the old strategy stopped working. Suppression only functions when supply can be summoned. When that lever breaks, the act of controlling the market becomes a liability. Survival buying took over, and survival buying doesn't negotiate. It doesn't wait for dips. It doesn't care about headlines or technical levels. It only cares about reducing exposure before it grows. Once that shift happened, the market crossed into a new phase. The mechanics that once absorbed volatility began amplifying it. Obligations stacked instead of rolling cleanly. Hedging requirements tightened instead of relaxing. Option structures that once capped upside began to strain under their own weight. And above it all sat $65. Not as a target, not as a prediction, but as a stress point, a level where the system's internal wiring starts to glow. The closer price moved toward it, the less theoretical the risk became. London flipping wasn't the cause of the problem, it was the confirmation, the moment when a market that had relied on control was forced into reaction. And once reaction replaces control, the path forward stops being chosen and starts being endured. At this stage, price itself stops being the story. Structure takes over, around $65 an ounce. The market enters a zone where behavior changes not because of emotion, but because of obligation buried deep inside the machinery. Heavy call option positions sit there quietly, invisible to most participants, shaping the terrain long before price ever arrives. As long as silver stays below that level, everything feels manageable. Premiums are collected, risk appears contained, the system looks calm because it hasn't been tested, but markets don't move in isolation. As price drifts closer, the mechanics wake up. Hedging begins slowly at first, almost politely, then faster as exposure grows. What was once passive turns reactive. Each dollar higher forces defensive buying, not by speculators chasing upside, but by market makers protecting positions they never intended to hold outright. This is where intent stops mattering. Math takes control. If price presses through that zone, the process feeds on itself. Hedging becomes acceleration. Protection becomes propulsion. Buying forces more buying. Not because anyone wants it, but because the structure demands it. Risk management turns into momentum. And momentum turns into pressure that no longer responds to persuasion. That's why price behavior here feels unstable. Sharp swings appear without warning. Sudden sell-offs hit the tape, aggressive and loud, but they don't finish the job. Instead of cascading lower, they stall, then reverse. Every push down is absorbed faster than expected, like the market is falling onto something solid instead of empty air. The reason isn't enthusiasm, it's absence. Supply isn't stepping forward. Metal that used to appear on cue no longer does. And the most recent price action confirms it. Even during global pullbacks, silver refuses to leave the area around $65. Domestic prices barely adjust. Buy-sell spreads stay tight. Dealers move carefully, conserving inventory rather than dumping it. That's not how markets behave when they're preparing to unwind. What looks like indecision is restraint. What looks like balance is hesitation. Sellers aren't confident enough to press. Buyers aren't patient enough to walk away. Both sides are waiting, not for confirmation, but for resolution. This is compression. Pressure building without release. A market coiling, not collapsing. And compression doesn't resolve softly. It resolves when the structure finally gives way. Not because of drama, but because there's nowhere left for the pressure to hide. This is the stage most people get wrong, not because it's complex, but because it feels deceptively calm. Sideways movement looks like stability. Flat price looks like equilibrium, but real stability requires willingness on both sides. It requires flow. What you're seeing now isn't balance, it's resistance. Liquidity begins to thin quietly, not all at once, but unevenly. Orders that once disappeared into the market now leave marks. Small trades move price more than they should. Volatility rises, but without direction. It feels erratic, almost random, yet deeply uncomfortable. Participants sense something changing but can't quite name it. That unease spreads faster than information. Traders hesitate. Dealers quote carefully. Everyone waits for a signal that never arrives. Commentators reach for familiar explanations, inflation, interest rates, geopolitics, because those narratives are comforting. They imply choice. They imply control. But none of them explain why pressure no longer releases the way it used to. Because this phase isn't driven by opinion, it's driven by contact. A leveraged system has encountered something physical, something finite. And when that happens, collapse isn't the first response. Adaptation is quiet. Uneven adaptation, the kind that doesn't make headlines. Rules begin to shift at the margins. Access becomes conditional instead of assumed. Contracts change language. Terms get tighter. Not announced, just implemented. Those closest to the mechanism feel it first. They shorten timeframes. They adjust exposure. They stop explaining and start positioning. Everyone else sees the effects later, through price behavior that no longer matches the old playbook. This is why the danger doesn't feel dramatic. Nothing explodes, nothing breaks openly. The market just becomes harder to navigate, harder to enter, harder to exit. Like walking through a room where the air has grown thick without anyone opening a window. And by the time movement becomes obvious, the structure underneath it has already shifted. Positions are set, obligations are fixed, the room to maneuver is gone. Silver doesn't need to surge to matter. It doesn't need headlines or panic. It only needs to stay expensive long enough for the system to accept what it's touching. And that acceptance is already happening, quietly, in places most people aren't watching yet. Pull the camera back far enough and silver slowly fades out of focus. What comes into view instead is something larger and far less comfortable. This isn't a story about a metal outperforming expectations. It's a story about a system discovering the edge of its own design. For decades, stability didn't come from strength. It came from flexibility. Contracts could be rolled, claims could be extended, exposure could be managed forward in time. As long as supply behaved like an idea, something abstract, responsive, negotiable, the structure held together. Promises substituted for delivery. Confidence filled the gaps. That only works until something refuses to behave like an idea. Silver never agreed to that arrangement. It exists in the physical world, governed by use, depletion, and delay. It doesn't accelerate because the system needs it to. It doesn't multiply because confidence demands it. When it leaves circulation, it leaves for good. And when enough of it does, flexibility turns into fragility. Every phase you've watched followed the same rhythm. Control was applied to calm price. Fear was injected to flush positions. Weak hands were removed again and again. But instead of restoring balance, each intervention exposed how little margin remained. Each reset tightened the float further. Each solution stacked new obligations on top of old ones. Eventually, the tools stopped working. Not dramatically, quietly. The same levers were pulled, but the response faded. Selloffs failed. Pressure lingered. Scarcity stopped being theoretical and began asserting itself through behavior the system could no longer smooth over. That's how structural change announces itself. Not with noise, but with persistence. Markets don't shout when the foundation shifts. They whisper through resistance, through price that won't cooperate, through mechanisms that keep running even when belief starts to fade. Silver didn't attack the system. It didn't expose a flaw through collapse. It did something far more unsettling. It revealed the boundary, the place where promises stop extending and reality takes over. And once that boundary is visible, denial loses its usefulness. Adaptation replaces argument, slowly for some, abruptly for others, never evenly, never comfortably, and never with a warning that gives everyone time to adjust. Every market has a moment where control quietly gives way to consequence. Not with drama, not with sirens, just with the slow realization that the old levers no longer move the machine. That's where silver is now. This isn't a prediction, it's a diagnosis. The signs are all there: failed sell-offs, tight physical pricing, institutions, changing behavior, pressure building instead of releasing. These aren't signals of hype, they're signals of limitation, and limitations don't negotiate. The most uncomfortable truth is that nothing here requires belief. You don't need to be bullish, you don't need to be bearish, you don't even need to participate. The mechanism runs regardless. Doing nothing is still a position. Waiting is still a bet. Assuming the system will behave tomorrow the way it did yesterday is still a choice. Silver didn't break the system. It revealed where the system ends. And once a limit becomes visible, adaptation replaces denial. Slowly for institutions. Abruptly for price. Painfully for anyone caught assuming stability was permanent. The market isn't asking what you think will happen next. It's asking whether you recognize what's already happening. Because the quiet before a structural shift isn't peaceful, it's tense. And the longer it lasts, the louder the resolution tends to be.